Good morning, everyone, and welcome to Bloomberg UK, a news show with a special focus on the biggest challenges facing the British government, the economy, financial services, and markets. I'm Francine Lacqua here in London. Now, on the show this week, the BOE Day. It's here in the city. We'll discuss that with the former Bank of England MPC member, Michael Saunders. Also on the program, we'll have more from our interview with the new chief executive of Shell on the latest results for the FTSE 100 energy giant. Plus, we look at how Chelsea Football Club were the driving force behind a record January transfer window for the English Premier League. Now, the Bank of England is expected to announce its 10th consecutive rate hike today. For more, we're joined by Danny Berger outside the Bank of England. So, Danny, as well as the Fed, central banks in Canada, Norway and Australia have also downshifted. Will the BOE do the same today?
Well, they have to at some point, right, Francine? I mean, they were one of the first to really start this rate hike cycle, but it's not clear that this is the meeting they will do that, just given how the data has been coming in. We've seen core inflation remain very sticky, private wage growth, that data coming in at 7.2%, and we're going to get their quarterly review today. We're expecting them to upgrade their growth forecast. You put all those together, Francine, that is not consistent with a picture that's moving back down to their 2% inflation goal target. So the market says 80% odds that we'll get 50 basis points today. What is the view forward? Again, all of this, as it usually is with the BOE, is uncertain. It is a very split MPC. For the past 3 meetings, we've had a 3-way split. How will it lean this time around? Again, the divide is between those who think the risk is over-tightening versus those who think the risk is under-tightening.
And of course, Danny, what we want to know is the pace of hikes to come. So how many clues will we get on that?
I think for this, the quarterly review will be very important. As I said, we're likely to get a stronger growth forecast. Given last time around, they did foresee us entering a recession at the end of last quarter. Growth was stronger than expected, so that will likely be a glass half full type of picture. But what they say about wage forecasts and unemployment, all of that will be key into seeing how they act going forward. The market at the moment thinks we're going to get at least 25 basis points worth of cuts by the end of this year. So we might have an Andrew Bailey that tries to guide the market away from that. It certainly will be a need for repricing in this bond market.
Thank you so much, our Danny Berger there covering the BOE today. Don't forget to follow our live coverage of the BOE decision with the MPC decision set to be published at 12 p.m. UK time, followed by the press conference at 4 p.m. We'll bring you our interview with Governor Andrew Bailey. Well, we're now joined by Michael Saunders, former Bank of England Monetary Policy Committee member. Michael is currently senior policy advisor at Oxford Economics. Great to speak to you, especially on BOE Day. Is there a danger that because the labor market is so tight, even if we do have raising expectations in GDP, slowing inflation, it's going to be really hard to hit that 2% target?
I think we're past the peak on inflation, and actually the Bank of England are likely to cut their inflation forecast for this year and next year because of the drop in gas prices that we've had since their last forecast in November. And they'll probably also raise their growth forecast, partly for the same reason, and also that the yield curve is a bit lower. But I do think there's a risk that inflation will be quite sticky. Core inflation, getting back to the 2% target is going to take a while. And for that reason, I expect them to hike 50 basis points today.
And then what happens after that? So again, if you look at it, I know it's almost a philosophical question because you also need to take into account the tightening that you've done in the past. But do they need to be aggressive now and then cool off as we get into the summer months? Or is it better to go gradually so that you see the effects of previous tightening?
Well, the MPC has now hiked quite a long way. Almost, I mean, if they do a 50 basis point rise today, that will mean that rates have gone up by almost 4 percentage points since late 21. So that's a big tightening cycle already. Look, I think in terms of judging the outlook for policy, assuming they do a 50 today, there are really 3 things which are worth focusing on. The first is the MPC do an annual survey of pay deals. This is done through the bank's regional agents who go out around the country talking to many firms. It's a very big survey. The MPC put a lot of weight on it. The survey a year ago said that pay growth would run at 4.8%. At that time, that was the strongest figure for pay deals that they'd had since they began that survey 15 years ago. And of course, that prompted the MPC to tighten. And we saw through last year average earnings growth repeatedly surprising on the upside relative to consensus expectations. Now they'll have the results of the new survey. They will come out in the monetary policy report today, I suspect they will show pay deals at least as strong as last year, perhaps stronger. In other words, 5 something, perhaps even 6%. And I think that will get the MPC worried about second round effects from the tight labour market and high inflation figures.
What does that mean for monetary policy then going forward?
Well, I think that's going to mean that the idea of a quick pivot from tightening to loosening, I think that's unlikely.
So the markets are wrong.
I think the market's just getting ahead of themselves for that. So first thing to watch for, as I said, is pay deals.
Oh.
The second thing is, what did the MPC themselves say about the future path of policy? So in the last few meetings, they said that they're prepared to act forcefully if they get more signs of second round effects, but also suggested that the terminal rate, the peak rate that markets have expected, is maybe too high. Now, that hasn't stopped them hiking rates pretty rapidly, 50s in recent meetings, even a 75 in November, because that guidance on the terminal rate, well, the terminal rate was a long way above where the actual policy rate was, so it didn't really constrain them. This time around, I would expect them to give clearer guidance that they are towards the end of the tightening cycle. Not necessarily finished, but near the end. And they may do that by referring back to the scale of tightening which they've done. But also, I would look at their inflation forecast with stable rates. In other words, where will inflation be if rates don't rise further from here? That may well be pretty close to target, suggesting that not much more needs to be done.
But when you say that the markets may be getting it wrong, they don't believe that actually we can stay at this pace, even if there's not more tightening, for a long time. Where are you expecting interest rates to be in 2024?
Look, I think, let's assume they go 50 today, so that takes bank rate up to 4%. Maybe a little bit more, maybe we have another quarter point or so after that. Maybe next year you might think about rates coming down a little bit, but I think it'll be pretty slow.
Yeah.
One of the key things to think about there is, before the pandemic, people used to think of a neutral interest rate, a normal interest rate, if you like, as being perhaps maybe at a high level, 2%.
Yeah.
And probably a neutral interest rate now is higher than it used to be.
At what level?
I would guess 3 something. That's the kind of interest rate you should think of as being normal, neutral for coming years, neither adding stimulus nor disinflationary. Higher than it used to be, because inflation expectations have moved up over the last couple of years, and so you need a higher nominal interest rate in order to achieve the same level of restraint. So even if the MPC do start to cut rates next year, you shouldn't expect rates to be going back down to the very low levels that we saw before the pandemic. I think the days of ultra-low interest rates are behind us.
I was going to say, do we ever go back to those days, even if it's in 4 or 5 years?
Not for the foreseeable future. Those were exceptional conditions, very low global neutral interest rates, a long period of spare capacity, a long period of very low inflation. And I think having been through the pandemic and then the experience of the last year of very high inflation rates, inflation expectations are likely to be persistently higher, requiring a slightly higher nominal interest rate.
We saw an uptick actually in the UK economy in November, which the bank had not forecast. Are there models that are broken that the bank should not be looking at, or should be looking at them differently?
No, I think the economy did slightly better than expected, it appears, in Q4. But I don't think this means that the fundamental assessment of the outlook is wrong. The UK economy has been hit by a big rise in energy prices. That's squeezing household incomes. The effects of that are coming through. Also a squeeze on company profits, many firms facing large cost pressures. The effects of that, plus the monetary tightening, is likely to cause the economy to go into recession during this year.
Is it harder to set policy? So we had the Fed yesterday, and we watched that press conference of Jay Powell. We have Francine Lacqua of the ECB today. Is it harder to set policy here in the UK right now, given all the confluence of events?
So the UK does face a combination of challenges, which in some ways are worse than either the US or the euro area. We have the high inflation, also you see that in Europe, driven by, in part by energy costs. But the UK has also had a drop in the labour supply, a drop in the workforce, because of a big rise in long-term sickness over the last few years. And that's reduced potential growth, and Brexit. And so the third thing I think that people really want to look out for today is the Bank of England do once a year an assessment of the economy's potential growth, what they call their supply stocktake. They will publish the results of that. I suspect that's likely to show that potential output growth in the UK is low, 1.25%, below what we saw in the pre-GFC period, but also lower than we saw in most of the last decade. That's adverse demographics, Brexit, a gloomier view, I suspect, on workforce participation, and persistently low productivity growth. Now, the MPC can't fix potential growth, but if potential growth is low, they are forced to restrain the pace of the economy to match that low potential growth. That acts, if you like, as a speed limit for what the economy can achieve.
There are concerns that actually investors haven't really come back to the gilt market like they have in the past, foreign investors. What does the UK need to do to get that back?
Look, I think the bigger picture is what the UK needs to do, not just to get back gilt market investors, but to get back foreign investment into the UK. Right? The path of business investment in the UK has really stagnated since 2016, since the Brexit vote. And that's part of the reason for low potential growth in the UK, and with that, low growth of living standards. Now, I think that problem is becoming more widely recognised. As I said, the Bank of England can't fix that, but the government can. The government really needs to come up with a coherent plan for growth, a way of improving the supply side of the UK. So far, that's been lacking.
What would you do?
Well, I think there's a well-known script of measures. You look at the things which the OECD, the IMF, the experts have been saying. Closer trade links with Europe, higher public investment, more money on education and skills. These are the standard measures to improve potential growth. The extra thing in the UK would be fix the issue of NHS waiting lists, because that's probably part of the reason for this big rise in long-term sickness, which has reduced the workforce and curtailed labour supply.
How do you fix productivity?
Education, skills, closer trade links with Europe, right? And none of that's easy. None of it, actually, I'd say closer trade links with Europe is a relatively low-cost thing to do. It wouldn't cost the country anything to do it, and it would yield relatively quick benefits.
Michael Saunders, as always, thank you so much for joining us. That was, of course, a former Monetary Policy Committee member at the Bank of England and now Senior Policy Advisor to Oxford Economics. Well, coming up, Shell's top boss cautions that we're not out of the woods of the European energy crisis yet. As the oil major reports bumper earnings, we bring you our interview next, and this is Bloomberg.
Supply is indeed constrained for multiple reasons, some of them geopolitical, some of them simply an underinvestment in oil and gas for a long time to come. But you also have multiple plays on the demand side. We mentioned China, but of course, you do see some recessionary concerns as well that are bubbling, higher inflation, higher interest rates. All of that coming together is going to have its own impact. So too difficult to predict where things go. Our focus is to make sure that we deliver the value out of our very strong core businesses, our upstream, our integrated gas, our marketing businesses, and that's where we will continue to focus.
But overall, do you think that the worst of the European energy crisis is over? Is it going to get better from here, or could we still see a lot of price swings and upwards pressure on prices?
I would not declare the end of the energy crisis. I think we have a way to go. The amount of rewiring of energy flows over the past year has been huge, and we expect to see that continue into the coming months and years. In 2022, the mild weather in Europe, for example, has helped in reducing some of the draw on energy. At the same time, there has been a destruction in demand in certain areas, in particular in the industrial sector. So this is going to be a journey of years. And I would caution anyone who looks ahead and assumes that the worst is over.
That was the Shell Chief Executive Officer, Wael Sawan, speaking to me a bit earlier. Now, the number of top earners at JP Morgan's Frankfurt division have soared since Britain voted to leave the EU 3 years ago. It comes as US banks look to ramp up operations in Europe in a sign of how Brexit has transformed banking in the region. Joining us now is Bloomberg's finance reporter, William Shaw. Will, great to have you here. So how have some of the ranks there of JP Morgan millionaires changed from London to Europe?
So back in 2015, which was the year before the Brexit vote, there were absolutely no bankers with JP Morgan in Germany earning more than €1 million a year. By 2019, that number had jumped to 9, and by 2021, which is the most recent year for which we have data, it soared to 85. And in fact, there were 7 bankers there the same year that were making more than 3.5 million euros. There's a couple of different trends going on there. First of all, JP Morgan's German office has expanded to take in a host of other European countries. Secondly, because of Brexit, the bank has been shifting really well-paid traders and salespeople to cities like Frankfurt and Paris.
So how has Goldman's approach changed to doing business in the bloc?
So we've got something quite similar going on with Goldman. So in the 5 years to 2021, their headcount at their German-based office increased 7-fold to more than 900. Now, we should point out at this point that their London-based office, Goldman Sachs International, has got a lot more people, about 3,800, but that number has actually been in decline now for a couple of years.
So does it mean they've turned their backs on London?
Certainly not in a major way at this stage. I mean, if you look at London, it's still got an £82 billion trade surplus in financial and related services. About twice the amount of dollars are traded here than are in the US. So in many respects, it's still doing well, but there are signs of a slide. So, for example, starting from 2019, the UK's share in foreign exchange and derivatives, in euro-denominated derivatives, have all fallen about 10%. So major problems aren't showing up yet, but there are signs that all is not well.
So what does it mean for London as a whole? How much has it suffered because of Brexit?
I mean, London still has got a major allure for bankers. It's obviously like a very desirable city to live in. People like the independent schools. They like the cultural life. It's difficult to get people to move to locations outside of London without them quitting. But at the same time, there is an inevitable sort of gravitational pull from the European Union, being assisted by European Union regulators, to pull more people away from London. And I think that probably will continue.
Well, thank you so much, William Shaw there of Bloomberg. Now, be sure also to subscribe to Bloomberg's podcast. It's called In the City, and it's out every Thursday. That's today. Coming up, Chelsea's record-breaking January transfer window. We'll take a look at their big spending spree in the Premier League. That's next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg UK. I'm Francine Lacqua here in London. Now, Chelsea Football Club have smashed the British transfer fee record, paying over £100 million for the Argentinian midfielder Enzo Fernandez. Joining us now to discuss all of this is Leanne Gerrans. Leanne, I mean, this was huge. What a transfer year. Like, Chelsea set a record. We hope we win a couple of trophies because of it, because we've been doing terribly. But what can you tell us about the deal?
Oh, so Francine, the transfer window is now officially well and truly closed. And all I have to say is records were just smashed across the board. We heard about that deal that Chelsea made there for Enzo Fernandez. But I also just want to say that the Premier League clubs together combined spent £3 billion during the last two transfer windows, so during the summer and the January one. But let's get back to this Chelsea deal. £107 million for a 22-year-old player from Benfica. We must remember that back in August, he was actually bought for £10 million. He won the player...
That's a premium.
Yes, I know. He won the Young Player Award at the World Cup playing for Argentina when they won in Qatar. And how much of his value has gone up now? 107. There we are. But as you said, Francine, Chelsea still 10th in the league. Graham Potter struggling, so they're spending all this big bucks, but where they're really getting.
So, but I mean, this is a more general trend, and of course I have, disclaimer, I'm a Chelsea fan, the only one in my family. I get a lot of hate because of it, so I'm watching this very keenly. But are we just becoming much more Americanized so that, more private equity bosses come in, they're just going to spend the big bucks?
So this is where we've really been looking. So as we do know, I was standing outside Chelsea, I don't know if you remember, but in March when that big transfer happened with BOE and Clearlake, when they took over Chelsea for all of those millions of pounds. And now we're seeing them really spend £500 million on players. So they are investing in the club massively. They've got so much money behind them, and it just looks like this big push to get big player names in. But Francine, as we've seen, this is just not pushing them up the league at all. Arsenal are still the league leaders, and they've actually just bought another Chelsea player for 12 million, and he's also a midfielder. So really, Francine, we have to see. And I know that I'm also a Chelsea fan. Can I say that too?
I didn't know. We should be in like Chelsea blue. We're going to get so much hate mail.
No, we're going to get loads of hate. But it's important to just note that, big money's been spent on football. And like I said, it's record-breaking £3 billion during the last two transfer windows.
Huge, incredible money. Thank you so much, Leanne Gerrans, there with the very latest on football transfers. Don't forget, of course, to follow our live coverage of the Bank of England decision, with the MPC decision set to be published at 12 p.m. UK time, followed by a press conference. And then at 4 p.m. we'll bring you our interview with the Governor, Andrew Bailey. Now, the picture is like this. We have a decision guide because of the Bank of England, but we also have then the ECB. There are 3 things that the Bank of England will want to make sure they communicate correctly. 3 things that you need to watch out for. One is market pricing, statement language, so we'll be bringing you that press conference live and in full, and of course the economic outlook. Are they going to raise GDP expectations and lower inflation expectations? This is the big question, and will they hike 50 basis points? This is Bloomberg.